Hi, and welcome to Tax Takes with me, Claire Karen. In this video, we look at the New Zealand income tax concept of allowable deductions. As you watch this video, I recommend that you have your candidate study guide and the quick reference guides open so that you can highlight and flag your learning materials. Remember that tax knowledge builds upon itself. You first need to master the fundamental concepts of tax and then move on to the specific rules and regimes. So what are allowable deductions? Part D of the Income Tax Act 2007 contains the provisions relating to deductions. To calculate a taxpayer's allowable deductions, you need to consider the general permission in section DA1, which permits a deduction, and the general limitations listed in section DA2, which deny a deduction. An amount of expenditure needs to meet the criteria in the general permission as a starting point, but then also not fall into any of the categories within the general limitations. At this point, the amount is deductible unless it is specifically denied in the rules in subparts DB to DZ. A specific provision may supplement the general permission by allowing a deduction when the general permission is not met. It may override the general permission to deny a deduction even though the general permission has been met, or it may override a general limitation to allow a deduction for a specific type of expenditure. In tax law, the most specific provision is the one that applies, so specific provisions will overrule general provisions whenever there is a conflict. So what are the requirements of the general permission? The general permission allows a deduction for any amount of expenditure to the extent that it is incurred in deriving the taxpayer's assessable or excluded income, or incurred in carrying on a business for the purpose of deriving the taxpayer's assessable or excluded income. Note that this doesn't include exempt income. Take a look at the Tax Takes video on assessable income for more information on these categories. There are three key concepts to note. The first is the term to the extent. This relates to the portion of the expenditure that is for a relevant income producing purpose. So the expenditure may be only partially deductible and require apportioning. The second concept is that the expenditure must be incurred. More on this shortly. The third concept is that there's a difference in the general permission based on whether the taxpayer is carrying on a business or not. A taxpayer who is carrying on a business can claim expenditure provided that it's incurred in carrying on their business and that none of the general limitations apply. In fact, a business can potentially claim a deduction for expenditure that does not result in any assessable income. So what are the general limitations? The general limitations are listed in section DA2. The first limitation is that the amount is capital or of a capital nature. The key tests for determining whether an expense is of a capital or revenue nature from case law are summarised in your core content. For example, where the expenditure will result in an enduring benefit to the taxpayer, it's more likely to be of a capital nature. It's important to remember that while a capital expense cannot be claimed as a general deduction, it might be included in the cost of a depreciable asset and thus included in a calculation of a depreciation expense. You'll learn about these specific deductions later in the module. The second limitation is that the expenditure is of a private or domestic nature. Payments for housekeepers or general upkeep of a taxpayer's home would fall into this limitation as domestic expenditure. Private expenditure would relate to personal expenditure, such as clothing or healthcare of an individual. The third limitation is that the expenditure cannot have been incurred in deriving exempt income, or in other words, if the income is not taxed, then the deductions incurred in earning that income are denied by this general limitation. The fourth limitation is that an employee is not able to claim any deductions incurred in deriving employment income, such as travel or parking costs, in order to perform their duties. The fifth and sixth limitations apply to non-residents. Any expenditure incurred in deriving passive income, such as interest or dividends, or income that has a foreign source, is not deductible to the non-resident. The passive income limitation is because these amounts will have already been subject to a final tax, which you'll learn more about later in the module when you study the international tax units. The foreign sourced income limitation is because these amounts are not assessable income of the non-resident, so the deductions incurred are treated in the same manner and are not deductible. So let's look at the concept of when an amount of expenditure is incurred. Section DA1 uses the term incurred to determine the point in time at which a deduction arises. The term incurred is not defined in the tax legislation, but instead is determined based on case law. Per James Flood's case, expenditure is incurred when the taxpayer is definitively committed to the expense. A series of criteria have been developed from case law to help determine whether an expense has been incurred. These are summarised in your core content. Some indications that an expense has been incurred may be that the expense has been paid, from Lau's case, that if the expense has not been paid, there is an existing obligation, from AM Bisley & Co.'s case, or that there's a liability that can be reasonably estimated, from the Mitsubishi Motors case. Generally, accounting provisions and reserves are not deductible as the expenditure hasn't been incurred. That is, there is no existing obligation that the taxpayer is definitively committed to. When an actual liability exists, the expenditure will be incurred and therefore deductible at that time. However, some accounting provisions relate to expenditure which are covered by a specific provision. The deductibility of these amounts will be determined based on the specific provision and not on the general provision. It's important to remember that there are different tax timing rules for income and expenditure. Income is assessable when it's derived, whereas a deduction is deductible when it's incurred. This means that even where a taxpayer uses the cash basis for determining the timing of derivation of income, or in other words, where income is only recognised once it's received, expenditure is nevertheless deductible when incurred. And as we just covered, expenditure does not need to have been paid to be incurred. Specific provisions within Part D essentially vary the general rules for specific types of expenditure and generally represent a policy decision when drafting the legislation. The core content summarises a number of the specific deduction provisions. You should ensure you know these in detail. A few key points to note are: interest expenses covered within the scope of this module include sections DB5 to DB8, which outline that the capital limitation doesn't apply to interest expenditure and that companies generally are allowed a full deduction for interest without having to meet any additional requirements other than that it has been incurred. Bad debts are deductible under section DB31, but only if an existing debt has been physically written off in the taxpayer's accounting records prior to year end, because a reasonably prudent commercial person would expect that there was no reasonable likelihood that the debt would be paid. An allowance or provision for doubtful debts for accounting purposes would not meet these requirements and so is not deductible. Legal fees are automatically deductible when they come to a total of $10,000 or less. This eliminates the requirement for taxpayers with reasonably small legal expenses to have to assess them for a split between capital expenditure and revenue expenditure. Where the total legal expenditure in an income year comes to more than $10,000, the capital limitation does apply. This does not mean that the deduction is automatically denied. It means that the entire amount of expenditure must be considered for whether it constitutes capital, either partially or fully. It is still possible to receive a full deduction for legal fees that total more than $10,000 if none of the expenditure can be categorised as capital. Entertainment expenditure is covered by sections DD1 to DD11. A common misconception is that all entertainment expenditure is limited to a 50% deduction. In reality, entertainment expenditure is a more complex set of rules that we should all be aware of. Take a look at our tax takes video on entertainment expenditure for more detail on this. Motor vehicles expenditure is covered in Subpart DE. The rules in Subpart DE apply to sole traders and partners in partnerships, and also to vehicles which have both private and business use. There are 4 methods prescribed that taxpayers can choose from to calculate the portion of motor vehicle expenditure that is deductible. Subpart E sets out the timing provisions, which contain specific rules about when a deduction can be taken rather than if. Some key issues are: for prepayments, the full amount paid is able to be expensed so long as the amount that relates to future income years is added back into the taxpayer's gross income. This has the same effect as allowing the taxpayer to apportion their expenditure. There are some exceptions to this rule in Determination E12 issued by Inland Revenue and able to be found on the ird.govt.nz website. The exceptions include upper limits in dollar amounts and in the length of time the unexpired portion relates to. Taxpayers who have expensed an amount for financial accounting purposes can receive a full deduction so long as their expenditure does not exceed either of the limits in the determination for their specific class of expenditure. The deferred payment of employment income provision in section EA4 applies to leave owed to employees, which for accounting purposes is often a provision for annual leave or long service leave. These are only deductible when the annual leave or long service leave is physically paid, rather than when the employee becomes entitled to the leave. The specific provision also allows, on election of the taxpayer, that amounts paid within 63 days of the end of the income year can be deducted in that year, as they indicate an impending liability within a short term, just like any other trade payables which may be paid shortly after year end. Lease inducements paid are covered by section EI4B, so this applies only to the person paying the inducement, which is usually the landlord or owner of the property. Deductions are allowed for these payments, but they must be apportioned evenly over the life of the lease. This video has covered the concept of allowable deductions. Thank you for watching. I look forward to chatting with you soon.